The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule. And that's all the rules there are.
If you spend any time reading about trading or investing, you've definitely come across those famous maxims and quotes from the legendary investor and fund manager Warren Buffett. Frankly, when I first got into investing, I held on to these as if they were gospel. They sounded so wise, almost like some sort of distilled wisdom of the markets. But over time, with many losses and a fair bit of experience later, the skeptic in me realized you got to take these quotes with a bucket full of salt. The truth is, most of these lines were said in a very specific context, but when we repeat them today, out of context, they often don't mean anything at all. This hit me again recently while I was rereading Taleb's Fooled by Randomness. There's this line in the book that stood out for me. What sounds intelligent in a conversation or meeting or particularly in the media is suspicious. What I like about Taleb is that he's deeply skeptical of conventional wisdom. He talks about the narrative fallacy, about how we get pulled in by simple, convincing stories even if they're completely wrong. And he's especially critical of mainstream media because its business is to simplify and package things so that it sounds good even if it makes no sense. But markets, as we know, are anything but simple. They're messy, chaotic, and quite layered. I'm your host Sandeep Rao, and in this episode, I want to dig into these Buffettisms, if you will, and help you make sense of them. I'll start with this one. Derivatives are weapons of mass destruction. I have many issues with the phrase weapons of mass destruction, but I'll leave that for later. As a derivatives trader myself, I get livid when people throw this quote out of context. Every time there's a news about someone blowing up in derivatives, suddenly everyone in social media becomes an expert. I've even heard people who never placed a single F&O trade in life quoting it like gospel. So I thought I should clear this up for once and for all. So where did this quote actually come from? Buffett wrote it in his 2002 Berkshire Hathaway annual letter published in the year 2003. Here's the full quote. In our view, however, derivatives are weapons of mass destruction, carrying dangers that, while now latent, are potentially lethal. The dangers are not just to those who deal in them, but to the system as a whole. Now, obviously, Buffett is a wise man, but context matters. He wasn't talking about all derivatives. He was pointing to complex, opaque, and highly leveraged products banks and hedge funds were churning out back then. Things like mortgage-backed securities, collateralized debt obligations, and credit default swaps, you name it. These were exotic instruments at the heart of the 2008 financial crisis. If you've seen the movie Big Short, you know exactly what I'm talking about. But here's the thing. Buffett wasn't saying all derivatives are evil. In fact, Berkshire Hathaway itself has used them many a times for different purposes. At the same time, we can't ignore the reality and the risks of dealing with derivatives. Talking specifically of India, most derivative traders lose money. SEBI's data makes it painfully clear. Around 95% of retail traders with turnover of under 1 lakh lose money. Even those with turnover about 10 lakh lose money, but just a little less. What this really tells us is two things matter above all else: being properly capitalized and sizing your positions right. Here's a simple example. Say you buy a nifty option at ₹50 on expiry day. It feels like a small bet, just 4,000 rupees out of pocket. But in reality, you're controlling a contract worth about 19 lakhs. That's nearly 500x leverage. Now, for a moment, imagine you got 40,000 in your trading account and decide to buy 10 lots. Why 10 lots? Because you can. A single adverse move is good enough to wipe out your entire account. If that's how you trade, derivatives do become weapons of mass destruction, just as Buffett warned. But position sizing changes everything. If you set aside 2 lakhs for just one lot, not a recommendation, just a illustration of sorts, your effective leverage drops from 500x to about 10x. Now 10x leverage is still not safe, but it's a world apart from the lottery ticket kind of exposure most people take without even realizing it. Being adequately capitalized is the only real way to size positions sensibly, and that's the only way you stand a chance of surviving in this game over the long run. If you approach it in a balanced way, you're not really gambling, and Buffett's weapons of mass destruction quote doesn't really apply to you. But if you treat extreme leverage like a lottery ticket, the odds of success aren't going to be different from actually buying one. I know I sound like a broken record here, but it's worth repeating. You've got to understand fully what you're dealing with. It's the only way to survive and maybe even thrive in this game. The way I see it is derivatives are like a Swiss Army knife of sorts. In the right hands, incredibly useful. But like any sharp tool, if you're careless, you can definitely hurt yourself. That doesn't mean you go completely off knives and scissors. You just need to learn how to use them properly. Now moving on to the second Buffett quote for the day. Our favorite holding period is forever. This is from the 1988 Berkshire Hathaway annual letter to the shareholders. The full line was this: when we own portions of outstanding businesses with outstanding managements, our favorite holding period is forever. He used it to explain Berkshire's philosophy of investing in businesses with durable competitive advantages, strong management, and the ability to generate consistent cash flow. The idea was, if you buy a truly outstanding company at a fair price, the best strategy is to own it indefinitely instead of trying to time the market or look for quick exits. It reflected Buffett's long-term ownership mindset, where investments are treated like owning a business outright rather than just trading in a stock. Now, importantly, Buffett didn't mean literally never sell. Berkshire has sold plenty of positions, airlines, IBM, you name it. The spirit of the quote was about long-term ownership mindset versus trading in and out. Now, if you look at it, the logic makes perfect sense for a fund manager like Buffett and his communication to his shareholders. But at an individual level, it can spell disaster, especially if we are talking about single stocks. Yes, there are indeed plenty of stories in India where people who bought and held on to Reliance shares ended up funding their children's education or daughter's wedding with those proceeds. But it's important to remember that Reliance is an exception, not a rule. Now, let me tell you something. Back when Reliance got listed in 1977, there were other names that were just as popular, if not more. Think of Dunlop India, the tire giant of its time, or Hindustan Motors, the makers of iconic Ambassador car, which was once a symbol of power in India. Or even Premier Automobiles, whose Padmini taxis ruled the streets of Bombay back then. All of them were market darlings back then, yet none of them exist in any meaningful way today. Reliance, on the other hand, kept evolving, diversifying and reinventing itself, and that's what made the difference. Now, what if you had put your money in one of those stocks? Would a buy and hold forever strategy really have worked then? These single stock stories are just that, stories. Work like charm in hindsight. But ask anyone who seriously studied markets and they will tell you not to take that kind of a single stock risk. The smarter choice always is to invest in a benchmark index. It's the simplest, most systematic, rules-based portfolio you can get, and it comes at the lowest cost. You don't have to worry about what goes in or what comes out of it, and if you still want to follow Buffett's buy and hold forever philosophy, an index fund is probably the safest way to do it. Moving to the third quote for the day, and this one is especially common on my X feed on days when markets are in red. Be fearful when others are greedy, and greedy when others are fearful. This quote appeared in Buffett's 1986 letter to his shareholders. He used it to explain his contrarian investing philosophy. That instead of chasing markets when optimism and euphoria are high, investors are better off stepping back, and that the real opportunities often lie in times of fear-driven selling when prices are depressed and others are too anxious to buy. Sounds great in theory, but in practice it's a lot messier. Let me explain why. First things first, who exactly are these others? Your friends and neighbors? Your banker? Fund managers? Twitter? It's never clear. And without clarity, advice can feel more like slogan than a strategy. Second, unless you have a solid framework, whether fundamentals or technicals, it's impossible to know what being greedy in times of fear actually means. If a stock is crashing, are you supposed to buy it just because it's falling? How much should it fall before it becomes a good buy? 20%? 50%? Take Yes Bank as an example. In 2018, it traded at around 400 rupees. Then the RBI declined to extend Rana Kapoor's term as CEO and the stock halved to 200 rupees in weeks. That was fear in the market. Should you have been greedy then? If you had, you would have lost nearly everything as the stock kept sinking. More recently, we've had a similar story with the stock Gensol. Sometimes even entire sectors can trap you. Look at Nifty Media since 2018 or PSU Banks from 2010 to 2020. If you had simply held on waiting for the fear to turn into an opportunity, you'd have sat on years of underperformance with no guarantee of recovery. Where Buffett's advice makes more sense is with broad indexes. Here the odds tilt in your favor. You can measure drawdowns, look at past crashes and convince yourself to step in during a 20-30% fall like we saw during COVID. Index investing gives you statistics and structure to anchor your decisions. But try applying the same logic to single stocks or niche sectors, it completely fails apart. Finally, there's a personal side to it. It's easy for a professional fund manager to say be greedy when others are fearful. They're anyways deploying other people's money. For individuals, it's not that simple. During COVID, many of my friends and family members saw their incomes cut or businesses suffer. How realistic is it to expect them to pour money into markets when they're worried about paying next month's bills? And even if you have savings to invest, without a clear plan to deploy, you'll probably just keep waiting. It's easy to say in hindsight, if the market crashes, I'll put in a lump sum, but actually doing that in real time is almost impossible and psychologically extremely tough. The other trap is waiting endlessly for the perfect dip. Sometimes those big corrections just don't come. I'm not exaggerating. I know people who've been sitting on the sidelines since March 2020, waiting for the index to return to what they call comfortable valuations. It's been over 5 years now and they're still waiting. I think the point is this: we need to contextualize the advice we hear. Quotes sound wise, but without considering our own life circumstances and behavioral realities, they can often be misleading. Now that brings us to the fourth and the last quote for the day. Never invest in a business you can't understand. Buffett has stressed on this idea in multiple Berkshire Hathaway shareholder letters and interviews, explaining that investors don't need to understand every company or sector, but they must be honest about the boundaries of what they do understand. In his 1996 letter, for instance, he wrote, "What an investor needs is the ability to correctly evaluate selected businesses. You don't have to be an expert on every company or even many. You have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital." This philosophy has guided many of his investment choices, such as avoiding technology companies for decades because he felt he didn't grasp their business models well enough. Only entering much later with Apple once he believed he understood the long-term prospects. The point he was trying to make was simple. You cannot be an expert at everything. Focus on what you can understand. Deep dive into those businesses you can understand. If you don't understand how a business makes money or what drives its future, you are not investing, you are speculating. For a moment, let's pause and zoom out a bit. Agree that Uncle Buffett makes a point. The one that you can't be an expert at everything, totally agree. Now here's where I differ. Just because you don't understand something doesn't mean you should shut the door on it. You can always seek the expertise of others and then make a well thought through decision. Now think of it this way. If you're faced with a medical decision, would you refuse a surgery simply because you don't understand it? Of course not. You'd consult multiple doctors, weigh in their opinions and then decide what to do. Now back to trading and investing. Instead of discarding an opportunity because it feels outside of your circle of competence, here's a better way to approach it. 1. Learn to identify and seek out genuine experts. Not easy, but an invaluable skill. 2. Understand the incentives of people advising you. The classic "don't ask the barber if you need a haircut" problem. Use the input to frame your decision, and if you're still unsure, play with allocation. Take a small bet. It's better than no bet at all. Now, like it or not, even Buffett has had his blind spots. By avoiding businesses he didn't understand, he missed the entire tech revolution, including names like Google. In fact, he publicly accepted this missed opportunity. Now, this is what Buffett said. "I knew the guys, I had plenty of ways to ask questions and educate myself, and I blew it." That's why I think the real challenge is figuring out if what's happening around us is wisdom of crowds or is it madness of crowds. What looks wise today can look foolish in hindsight, and what looks foolish now can end up looking visionary later. And that's why maybe the real answer isn't about making a prediction, it could be more about constantly updating our own biases. In investing, that means staying active with your decisions, paying attention to the information embedded in the prices, and acting on it rather than trying to forecast the future. Maybe it's the trend follower and momentum investor in me speaking, but honestly, I don't see a better way to deal with the uncertainties of long-term decision making. So here we are. We walked through 4 of Warren Buffett's most quoted lines, the ones that have been repeated so often that they've turned into maxims. The problem isn't Buffett or even the quotes themselves. The problem is with us, our tendency to oversimplify, to grab on to wise-sounding one-liners, strip them of their original context, and then apply them wherever we please. That's fine if you're just making a conversation for the sake of it, or if you are a talking head on a television with no skin in the game. But if you are a trader or an active investor, your money is on the line. You can't afford to be careless and irresponsible. So the next time you come across one of these quotes, pause. Don't just repeat it. Ask yourself, what was the context? Does it still hold? Does it apply to me? That's the only way to turn borrowed wisdom into something useful. I hope you found this perspective of some value. Share your thoughts and comments and I'll do my best to respond. Thank you for watching and see you soon.